I want to tell you a very little bit about our organization, just so that you all know that we are often referred to as small but mighty, and that's because our paid staff is very small. There's only 5 of us, and we are, believe it or not, a national organization, but we have an incredible core of volunteers. That's what makes us able to do what we do. So my name is Amy Bach, and I am the co-founder and the executive director of United Policyholders. As you all know, this fall was brutal, and so just this week, and brutal in terms of disasters, we hosted a workshop in Ventura, in Napa, here, and simultaneously tonight we're hosting one in San Diego where there was a fire called the Lilac Fire. So it's small comfort for all of you to know that you're not alone, I know, but United Policyholders is here for you. We are planning to be here for you through the long-term recovery, and we're getting ready to do a survey, which we're gonna, we normally wouldn't do it for 6 months, but because your recovery is actually moving at a much faster pace, believe it or not, in terms of your community and the coordination that's going on, we're going to do our survey normally earlier than we normally do. And one of the reasons for that is how many of you are trying to get a waiver of your contents inventory? Okay. How many of you have already gotten a waiver from your insurance company? Okay. So you know that that's a hot issue. The insurance commissioner, under some pressure from our organization and a lot of you, and also because of the complaints that his office has been getting, and because of the good work that people like Matt Kwan and some of your other group leaders, your insurance group leaders, have been bringing so much good, positive pressure on insurance companies to do the right thing here. We are getting some positive results with insurance companies removing that paperwork obligation. Unfortunately, not all insurance companies are doing it, and not all insurance companies are doing it for all their customers. So I want to just remind you that rumors are flying around like wild, and if you, and our advice on this is you still need to tally up your losses for your income tax purposes, or if you are going to join one of the lawsuits against PG&E, and for other, just to know, have your, basically your arms around the dollar amount of your losses. You still want to do it. You doesn't have to, even if you get the waiver, you don't have to list every salt and pepper shaker kind of thing, but there's that. If you are trying to get the waiver, we have already walked you through in previous workshops our guidance. We have a sample letter on our website for that. And again, you can ask for the waiver, but understand that it's not the end of the world if you don't get it. And United Policyholders gives you lots of help and free resources to get those lists done. We give you a free Excel spreadsheet at our website. There's a completed inventory on our website that you can use. There's the memory jogger in our yellow book. There's our app, the UpHelp Home Inventory app. So if you got the waiver, great. If you didn't, don't despair. It's still early, believe it or not. It's still early. There's lots of concessions that you may still get along the way. Okay, so we're going to get into tonight's program. I want to thank Trey up there in the booth, a Santa Rosa High School student whose family lost their home. So thank you extra, Trey, for being here as our AV guy. He's up there doing his homework, right on, okay? I want to thank our partners, the City of Santa Rosa and the County of Sonoma, who have, right out of the box, came to one of our workshops, liked what we were doing, jumped on with us, and we're coordinating. So we'll be doing more of that in the months to come. But again, where we started out was on debris removal. We've got someone here tonight to answer some questions on that. I want to thank our volunteers that are here. Trey, if you can go to the next slide. Here we go. Okay, so about UP. Well, we're a not-for-profit charity. We educate and advocate for you, the insurance consumer. We're funded by donations and grants, not insurance companies, to keep our independence. Our online information is all free of charge, and our team includes volunteers from prior disasters and knowledgeable consumer-oriented experts. Consumer-oriented experts, okay? That's, you guys are the consumers, we're oriented in your direction, we don't see you as customers or clients. We see you as policyholders. That's how we refer to the people that we help. People who have bought insurance and need to get the full value that they have paid for. You can learn more about our work at our website, uphelp.org. Okay, next slide, please. Fine print. The information provided in this program is intended for general education purposes only. It should not be construed as legal advice. We would love to provide free legal advice to every one of you. We cannot do that. The speakers at today's program are volunteering their time as educators. United Policyholders does not endorse or warrant the quality or services of any volunteer or vendor identified in our educational materials. So all the folks here in the back are here to give you information. They're volunteering their time to be here. Next slide, please. Tonight's speakers are going to be myself, briefly, Michael Musson, who's with Lincolnheimer CPAs and Advisors, Eric Goldschlag with Opus Advisors, and Matt Everson, who's a certified financial planner, retired, who has been a volunteer for us since right after the fire. So thank you, Matt, Mike, Eric. And we have a special speaker, Greg Walsh, who's with the Sonoma County Assessor's Office. I want to recognize Bill Keller back there with Community Bank of the Bay. His bank has been great. They've supported our work. We've got Everbank. Laura Levine is here. She's going to say a few words. Where are you, Laura? Here, you want to come on up? Is on our board. I want to thank Pam Schmitz with the Brio Financial Group. I'm not sure she's here yet. Also on our board, volunteering to help tonight. Castelli Vineyards, my old friend Laura, who's been helping out since the fire with our program up here, and Camille Pope, who's here helping us. Laura, did you want to introduce the folks in the back?
Sure. Thank you, Amy, and thank you to all the volunteer banks that came out today, and special thanks again to Bill Keller and Community Bank for all of their support. That's Bill back there in the corner. And I want to introduce the other banks that were here to volunteer with any information. First, I'd like to introduce Dan Garcia, he is a mortgage loan officer, construction expert, and he also is a Santa Rosa resident here in the community. Jennifer Foster came out with the Umpqua Bank team. I saw Jennifer, Roger LaForge, Greg Loberg, Mike Lee. Did I miss anybody? No? Okay, thank you. One of the first loans I got to do at Everbank was for someone who lost their home in a fire, and they added a second unit. So as you're making decisions, if any of my colleagues at any of these banks can provide information, wonderful. And if any of your other banks that aren't here, feel free to have them give a call. We could use support of all of our colleagues to work together to help you.
Thank you, Laura. And Laura has been volunteering on the United Policyholders Board for a number of years, and she is herself a mortgage expert and has some clients who are going through some issues related to the fires. And again, our purpose here is to give you information, not tell you what to do, but to give you data points, pieces of information to help you with the many decisions that you are grappling with right now. So we invited, there are 4 resources in the out there as well that you can take advantage of at the end of the program. Sonoma County Recovers Resources, information from the city and county on recovery and rebuilding, the permitting process. FEMA is here. Thank you, FEMA. Available with information on rebuilding stronger, and best practices for rebuilding in this region. And again, FEMA is here with some of their disaster case management team. So if you have questions about an individual assistance grant, or they probably can answer SBA loan questions, they're here. So thank you. We also have the United States Army Corps of Engineers here to answer questions about your favorite topic, the government-sponsored debris removal program. So thank you to the Corps of Engineers for the work you're doing, helping the cleanup go safely and smoothly. And again, these folks are here to answer questions. These are just, you are all familiar with the Yellow Book. If you haven't gotten one, and we ran out, but we will be bringing them to every one of our workshops. You can also email info@uphelp.org and put in the subject line, need a Yellow Book, and we'll get one to you by mail. That's just a picture of our UpHelp home inventory app, and that down there, uphelp.org/download, is a shortcut to all of our inventory help tools that I was mentioning earlier, the spreadsheet, the sample, etc. Okay, next slide. We offer 24/7 help on the web. These are just some of the things we offer: sample letters, sample reports, links to pro-consumer professional help. A lot of you have been starting to ask, a lot of you who are underinsured have been starting to ask, should I be hiring a lawyer? If so, what kind? A number of the lawyers who specialize in helping underinsured policyholders have been in our family for years, and you will find them in our Find Help directory. Videos of the past workshops. So we're a little behind on the, we've got all the workshops we've done through December 7th are up there on our website. So if you missed something or you have a friend who missed it, tell them to go to the website and they can find it there. These are just some of the publications that we offer that are relevant to the subject matter tonight. Professional and past survivor guidance on decision making, sample scopes of loss, sample contracts, a publication called Rebuild or Buy, Your Rights Related to Replacing Your Home by Buying Instead of Rebuilding, Rebuilding 101, which is avoiding construction snafus, getting your lender to release your insurance money. We have a publication about that, and some tax strategies for disaster survivors. So again, if we will be putting this video up, but we have done tax guidance workshops in the past for wildfire survivors, and you can watch those videos as well on our website. But this one from tonight will be available within a week or two, I hope. Okay, next slide. We've consolidated as much as we can to make it easy for you. The materials that are most relevant to your situation, we've put them into our North Bay Fires library. And then finally, you can register for our Ask an Expert forum. I've had a couple people say to me, I tried to call your office and I couldn't, and the sad fact is we don't publish our phone number very prominently because we just don't have the manpower, the woman and manpower, to answer one-on-one questions as quickly as we'd like to. So we have set up something called an Ask an Expert forum. And you can register, it's free, you can ask your questions, and we have an incredible core of people who answer those questions. So I encourage you to do that. Greg Walsh with the County Assessor's Office, could you just give us a quick explanation of what kind of help these folks can get from the Assessor's Office?
Thank you, Amy. Thank you for giving me the opportunity to come and talk with you today. There's a few points I want to talk to you about property tax assessment. So, as my boss, Bill Rosa, says, I'm not the tax collector. If you differentiate between the tax collector collects the taxes, the assessor is the one that sets the value on the property and gives all that information to the tax collector, and then we work jointly together to do that. So, kind of the differentiation of what we do. So, I want to focus back on, when the fires happened, and like you, I was affected by the fires. I live in Coffee Park, and I was fortunate to have my house still standing, but there's still issues to go through. So I thank Amy for for the workshop she's doing here. I attended the one at the church last week and heard that information. But as far as like the LAC Center, going back to the one that was on Mendocino, they gave a lot of good information out from the county and the state and so on. And there, our office, the clerk, recorder, assessor, we handed out a lot of address changes to have people change where their tax bill gets mailed to. The other thing we did was we provided like birth certificates, death certificates, and so on. And we did that at the LAC Center. We also did that at our county facility on Fiscal Drive. And we actually handed out enough documents that if we had charged people for it, we ended up doing that as a free service. But it would have amounted to $250,000. So that was a real service that we wanted to do for the county, and I think we achieved that. If you have questions about assessment and the fire, definitely go look at our website. So it's if you look for Sonoma County and then it's .ca.gov and then look for assessor. So you'll find a lot of good information. Our tax roll, people are wondering, well, what's going to happen? We're going to get less property taxes. Yes, that's true. Our tax roll, the assessed value last year was $85 billion. And the adjustments due to the fire, it looks like that's coming in a little under $2 billion. So we say, well, the county's not going to go broke, but they are going to have to make adjustments to it. So just to kind of keep that in perspective. A lot of people want to know about our process. How did we adjust values downwards? A lot of that was done by the information from CAL FIRE and the Sheriff's Department and all the inspections that they did. They went around and took pictures of buildings as to were they there, was there burns on part of it, and so we didn't have to go out to as many properties as we thought. So we've already adjusted probably 90% of the properties that had to have tax value reductions, and we've done that in just a short time. Just to kind of keep in perspective, I was talking with Calaveras County, and they had a fire, not as large as ours, but it took them 22 months to make their property tax adjustments, and we're going to do that probably under 4 months. So I think we're accomplishing a lot. Some people are asking about, building back. What size can I build back to? Can it be the same thing? And the answer is yes, you can build back and keep your property tax base as it was. It should be a similar size and quality. So if you do build back larger than that, you will have to pay an additional market value just on that portion that goes above it. So you still get to keep your low Prop 13 tax base on the original size of the property. Some people have heard rumors about, can I build a granny unit and not have to pay an additional taxable amount on it? And the answer is no. There's guidelines for permit fees, and those I think have softened, but you'd have to check with the permit departments. But as far as assessment goes, we do have, if you build a new building that wasn't there before, we do have to assess you for that, unfortunately. The other information that's going to be helpful to people, there's going to be some people here say, I don't want to rebuild. I think I might want to just buy another house somewhere else. And you can do that, and you can get the tax benefit of transferring your tax base to a new property, even though you're going to be paying a higher market value for that. You could transfer that, and you can do that up to 120% of what your property was worth the day before the fire. So say if it was worth, kind of the median house price, it was about $600,000. So you could go up to 120% based on that, whatever that figure is, and then you could transfer that over to the house you're buying. So our website has a lot of good information on that. I'll keep it short, and I'll answer some questions later. Thank you.
Thanks, Greg. Just real quick, if you don't mind, before I get started, if you do get questions during my presentation or Eric's or Mike's, hold them to the end so that we could get through the presentations, and then that way we'll have a long time for questions and answers at the end. I'm Matt Everson. I'm going to move a few of these things out of the way. But I sold my financial planning firm in August with an idea that I maybe would help give back to the community that's given me so much. And then the fires hit 2 months later, and I found all kinds of opportunities to volunteer. I had put on my Facebook page that if somebody's going to maybe have some frustrations with their insurance company and you're a friend of mine, just give me a call. I'll help you out, because I have a lot of experience with insurance companies, both inside and over the last 20 years on the outside, advocating for clients. And one of the survivors of the Oakland Hills fires hit me with an email real quick saying, you don't want to offer that. You should go hook up with United policyholders instead. They've already invented that wheel, and you don't want to reinvent it. And so I immediately reached out and I said, do you have room for a volunteer that has the knowledge that I do as a financial planner, but I'm not looking for clients because I sold my business? And she didn't believe me. She thought I was maybe not selling my business. She couldn't believe that somebody would offer that. So it's been humbling, though, for me to serve this group of fire survivors here in town. I'm from Novato, but I've been in Santa Rosa for 20 years. And it's obviously a tough time for us all to get through this, but United Policyholders is really not just survivor focused, they're focused on helping everybody get this done right, and I think it's one of the few forums in Sonoma County where there's not an angle and that you can trust the information. So what we wanted to talk about tonight was sort of the challenges financially that you might face. I have to tell you, from the legal standpoint, this should not be construed as financial advice. I'm no longer a financial advisor that's registered with the government, so this is purely educational tonight. There's a multitude of challenges that you're faced with. You're already aware of this. Just a few of them, though. Can I afford to rebuild? We'll talk a little bit about that tonight. Eric, in particular, the mortgage expert's going to talk a little bit about that. How does this impact my retirement and college planning, maybe? What will my real estate be worth in a couple years if I do rebuild? How can you get what's owed you from these insurance companies? You paid your premiums, you purchased a specific policy, and now there's this discovery from a lot of us that the insurance companies don't just simply want to give us what those maximum policy limits are. I'm going to talk a lot about that, actually. What sort of loans are available? Again, Eric's going to touch on that. And so if you can go on, Trey, to the next one. And the tax considerations. Mike is with one of the larger tax firms in town, and he's also a fire survivor. So he's very well versed on what issues and what opportunities exist for people that are in your shoes. The first question that popped up in people's mind probably was, am I properly insured? Show of hands, how many people in this room feel like they were underinsured? Okay. So I have to start with a little analogy about insurance companies. I surprisingly got a degree in French. And my dad said, now it's time for you to move out, and I needed a job. And so I took a job with an insurance company, not knowing an insurance policy from a hole in the ground. But what is very similar about insurance companies and learning another language, I was told by a French professor as I was struggling with subjunctive tense. Anybody remember the subjunctive tense? He said, as long as you keep trying to make French translate directly into English, you will never learn French. As long as when you start to decide that you'd like to learn French the way the French speak it, is when you'll begin to learn French. Insurance companies and the policies that they have make absolutely no logical sense, okay? But if you try to make them make logical sense for you, you'll continue to be frustrated. So the approach with insurance companies is not to say, how come, why do you need that form? This is ridiculous, can't you just trust me, The approach is, what form do you need and who do I get it to? And as soon as you accept that these companies are not going to change their policies because we've all gone through a community tragedy, the less frustrating it is to deal with them. It's still going to be frustrating though, just like the subjunctive tense. There's a lot of financial considerations. Some of us have kids, they go to schools, some of us have careers around here. Your home in general, in my practice over the years, people's home was their largest asset, so it's probably one of yours. There's some people that had their homes completely paid off. Some people owe quite a bit if they just recently purchased it. There's a big question right now, talked about get your insurance money and move somewhere else. That is certainly not a buyer's market right now in Sonoma County. There's not a lot of inventory, and now there's a lot more people seeking those same low inventory of homes. So we'll talk a little bit in high level about the market. And can you take the insurance and not rebuild? I'm not going to spend a lot of time. I think you all are aware that you can do that. That is actually grace of this United policyholders and some of the work that they did after the Oakland Hills fires. In some states in America, you can't. You don't have that right. The California Department of Insurance made that law here that it's your insurance money. You can do with it what you please as long as you pay off your mortgage. Go ahead, Trey. So let's talk a little bit in general about financial goals. And then afterwards, what I want to tell people, if you don't have a financial advisor, this might be a time to go interview one. If you do have a financial advisor, they're really going to earn their keep right now. They should be offering to help you through these decisions. And if you pay them, and most of you do, if you have one, they shouldn't be balking at helping you work through these decisions. It's difficult to consider all the different ramifications. But some of the questions I've been getting is, should I tap my 401k or my IRAs or my SEP IRA to rebuild? That's a very individual decision. If you're underinsured, which the majority of the room feels like they were, it's an option. It's probably not a good option. Okay? Eric's going to talk about the loan options. It's highly taxable to pull out of these accounts if you're not over the age of 59 and a half. So really think long and hard about doing something like that. If you are over the age of 59 and a half and you do have these type of accounts, it's still a pretty high tax way to get money to build a home. So there's other ways to work around that. Oftentimes a 401k or an IRA can be used as collateral. Depends on the bank. So have a look at that. As opposed to using that money, use a loan that's backed by that to some degree. The biggest thing is, where do you want to live? I've heard people saying, I'll just take the cash and I'll move to Arizona, and I'll just take the cash and I'll get out of town, or I'll move up to Cloverdale, whatever. The home has always been a confusing part of your asset structure here in Sonoma County in the Bay Area because of its high value. People see them as investments. But if you purely look at financial and investment advice, your residence is not an investment. It's where you live. And how you should determine whether you're going to live there is whether it's cheaper to pay the mortgage or the payments on that home than it would be for rent. And how does that fit in with where you work and where your kids go to school and where your friends are? So one of the biggest things I want you to try and take away, and this is a difficult concept, is that the home itself is not an investment. And I can prove that to you. I grew up in Marin, and my mother just sold her home. She had it for 45 years. She bought it for $25,000 back in 1968, and I lived there my whole life until I moved out for college. We sold it for $800,000. So show of hands, who thinks 25 to 800 is a good investment? Nobody? I mean, usually people think turning $25,000 into $800,000 is a good investment. And it is, but when you consider the time frame, it was 45 years. When you consider that she didn't buy it with her money, she got a loan, and then she refinanced, and then she refinanced over the years. She paid an interest rate that whole time that pretty much kept up with, when you do the math on that 25 to 800, it's a 7.5% rate of return, compounded annually. Okay? But if anybody in here remembers what interest rates were through the 70s, they were right around 7, 8, 9%. Okay? So for the first 30 years or so, that investment got washed out by the expense of the loan. And then, so if you factor in your property taxes and inflation, what she netted after all of that was a 1.2% rate of return over 40 years in one of the world's best real estate markets. This is why, and we'll get to this point later, the folks that are buying up these lots, the investment groups, they're not buying them up to build homes and flip and sell those homes for the most part. They're buying them up to garner the income. So when you're buying real estate for an investment, you're typically looking at what kind of income or cash flow it's going to produce, not the price appreciation. So try to keep that concept in mind. If that's a confusing concept, I'll find a better way to explain it later. But if you remove the fact that it's not really an investment, it's more of your home, that second bullet point, that third bullet point works a little easier in deciding whether I should stay here or not. I talked about the financial planner point. You should really lean on your financial planners right now if they're the kind of planners that do plan and not just sell things. So work with somebody that's really interested in helping you plan through which is probably one of the biggest decisions you'll make going forward, is where to live and whether I should rebuild and how to do that. Mike's going to talk more about accounting stuff. I'm going to skip over that. There are a lot of tax issues to be dealt with. And there's a big unknown, and that's something to be considered, though, especially in some of the more fire-prone areas, is what will insurance cost, or can I even get insurance after I rebuild? So that's difficult to answer, but it needs to be considered. Next slide, Trey. I did the French thing already. I told you about that. Being inside the insurance company, I was in the policyholder service department early on. And for whatever reason, they parked us right next to the compliance and legal department. And this office that I worked in was one of those open offices, no cubicles, no walls. Everybody's desk was right next to each other, and you could hear what everybody was saying. So I got to hear the attorney for this insurance company all the time. And what I learned was that if you push hard enough and nice enough and you have the right way to support your argument, almost everything involved with insurance companies is negotiable. They will make exceptions to their policies. You just have to show them the right way how to do that. The right way how to do that is not to yell at the person that makes $13 an hour and is totally inundated right now with claims. It's a very frustrating thing to talk to insurance companies sometimes because they don't speak our language. I saw it time and time again, these customer service agents and the policyholder agents and the adjusters, they know their processes inside and out because they do it daily. For whatever reason, they expect you to know that too. And when you don't, they can get obtuse, they can get empty-brained, they can sound as if they don't care about you, and that can get people angry. And the biggest thing, imagine a desk with 15 manila folders like this, 25 manila folders like this. Those were all my cases. When somebody called up and was giving me an attitude, I just took their file and I moved it to the bottom. I just did. I'm a human, right? So I know you've gone through really probably one of the toughest things in your life, but try to keep that in mind. They can control whether this is easy for you or not. So try your best to be sweet with them, be patient with them, understand that you're not probably the only person they're helping today, and get them what they need. And so that's that. Work with the contractor. Okay, has that been easy? Finding scope of loss reports, I'm hearing, is difficult. Amy might talk about that a little bit later, but that's one way, whether it's the contents list or this scope of loss report, to get them to negotiate a better settlement with you, if you can find something like that. So again, this is a business for them. I think we all know that by now, but there's a lot of hyperbole that goes around, that they're evil, that they're greedy, that they're this, that they're that. Really what it is they have a box to check. When they make that and they cut that check to you, 80% of that, let's say they cut a check to you for $500,000, they also have insurance. They have what's called reinsurance. They're going to turn around to that reinsurance company and make a claim. And so that reinsurance company is going to ask them, why did they give so-and-so a check for $500,000? As long as they've got their boxes checked, they will get $400,000 back from that reinsurance company. That's the large part of why they've got all these crazy processes, is because they need to have their ducks in a row when it's time for them to go get their insurance claim. So work with them and you'll find that you should be able to get most things. And it's going to be frustrating. I'm not trying to say it's going to be easy, but you should be able to get most things the way you need to get them. A lot of you can do your own taxes in a standard year. I would not recommend that this year. Mike's going to talk about all the different crazy provisions, and of course our Congress kindly passed a brand new tax code, or tax, what do they call it, Mike? The Tax Act that just went through. It's pretty confusing. They used to say that the tax code is equal in distance to 2 full Bibles. I'm not sure if this new tax revision shortened it at all, but I do know it made it more confusing. So this is not the year to use TurboTax. If you lost your home, I would suggest you sit down at least once with a CPA to make sure you don't miss out on some of the opportunities that might be there for you. And for the loans, you know, what you want to do with the loans is talk to somebody that knows all of the options. Eric's going to talk about several of them here next. There are a lot of options. Not everybody qualifies for them. So it's really important, what I've found over the years in working for my clients with mortgage brokers and mortgage advisors, is some are better than others. The more experienced ones will have their finger and their pulse on all the different options that are available for you. And what was that word you used earlier? Consumer focused?
Consumer oriented.
Consumer oriented, okay? Find somebody that knows what you need and is willing to go out and find it, you know? I think that there's going to be a lot of need for financing for folks up above what they get on their policies from their insurance companies. So financing is probably going to be an important part of this structure, and you want to have an expert in your stable. Go ahead, Trey. Is there any more? No. All right. Well, thank you for your time. I'll stay here, and we'll have questions afterwards. And now it's going to be Eric's turn.
Okay, I just, a couple of words from your sponsor, United Policyholders here. The reason that we decided to cover this topic tonight is, you know, we have already covered we did the orientation on how to speak insurance, figure out how much the maximum available under your policy would be. We talked about the importance of trying to get to an agreement on your coverage A, on your structure, the value of that. We then talked about your contents inventory, and we obviously a lot of people now are in your position are trying to evaluate what options they have if they're underinsured. That's a big one, right? And so that's why we decided to do this one tonight, because you've been treated to lots of presentations from lawyers who are ready to represent you in a lawsuit against PG&E, which would, I'm sure you've heard some, how many of you have gone to one of those presentations? Okay. So you know that the one, there are two things I want to tell you about becoming part of one of those lawsuits. It's become sort of normal when there is a potential, after a wildfire, there's a potential to hold the utility responsible. That is a way to be made whole in terms of your emotional losses, and if you're underinsured, whatever losses your insurance doesn't compensate you for, that is a way to get compensation. And of course, most of these firms, in fact, I think all of them are working on contingency. So it is, generally it's going to be a gamble that people will take in your situation if they feel comfortable doing it. And we have a lot of volunteers in our family who were part of class action suits against SDG&E out of San Diego. We have a lot of people we helped in the San Bruno fire. So again, if you have questions about participating in one of those lawsuits as a way of being made whole, you can put them into Ask an Expert, and we will do our best to answer them. Another way people deal with being underinsured is they move the pockets of money around. They'll take some of their personal property money and apply it to the rebuild, or they participate in a group rebuild and save money by joining up with their neighbors and hiring a geotech together and that kind of thing. Another way is lending options, and that is the primary topic we're here to cover. Is if you were to take out a construction loan or or an SBA loan, or what might you want to do with your existing mortgage. And these are, again, individual, personal decisions. Some people, we talked about this at the last workshop, some people decide to take their insurance money and pay off their mortgage because they don't want to deal with having their lender stay involved in the process. Some people decide that they don't want to do that, and you heard one of our speakers last time say, and this is true, that when a lender is working with you on fund control, that is for your protection as well as theirs. Because not only is good construction help hard to find in normal circumstances, but it's especially hard now where there's a lot of competition. You don't need me to tell you that, for good construction professionals. So again, These are all decisions that other people have made before you. You're not going to be the first one, and there's lots of guidance available. So our next speaker is Eric Goldschlag. He's a mortgage advisor with Opus Advisors, another local Santa Rosa resident. All of our panelists tonight live right here in your community. And he has personal finance and real estate expertise, and I believe a little bit of athletic coaching as well. So maybe you know him.
Good evening. Thank you all for being here this evening. I've noticed on the stage there's a trap door. How many of you feel like you're just about to fall through that trap door? All right. You've been sitting here for a little while, so let's get just a little bit of blood moving. Who here has not decided whether they're going to buy or whether they're going to reconstruct their home or they're going to sell and move? How many of you have not made that decision? How many of you are here to get as much information as possible to make the best decision possible? Excellent. And I applaud all of you for doing that. The best decision is an educated decision, and that's why you're all here. We're here to explain what all the different options are. One option may be better for one person than the other, but as long as you make an educated decision, that's the best one, and everybody's fit is different. So, kind of faded there. All right, what are some of my options? Stay, rebuild. What happens to my property tax assessment? What happens if I keep my land but move out of the area? Do I still have to pay my mortgage? Do I still have to pay my taxes? Do I still need insurance for vacant land, something that's empty? Those are some of those considerations that you want to think about. We're going to talk a little bit about what happens if I move temporarily while I rebuild. Is that possible? Can I do it as a tenant? Can I do it as an owner? Where do I go? What happens if I move permanently? Can I still keep my lot? Can I sell it? Can I give it to somebody? Starting to think about some more options here. What if I was a tenant and not a property owner? Anybody here lose their home as a tenant, not as an owner? Okay, a couple of you. There are options available for you as well. And then how do I get financing? Let me give you a very quick synopsis of how lending works in general. Lenders look at three things when they're going to lend people money. They look at someone's ability to pay, their willingness to pay, and the risk involved in the loan. The ability to pay is the one that's most regulated by the government. Who remembers the mortgage meltdown of 10 years ago now, right? The real estate meltdown. So the government says we really want to focus on ability to pay. So lenders look at how much income you have coming in versus how much debt you have going out. That includes car payments, student loans, property taxes, insurance, current mortgages. All that goes into that qualifying ratio, debt to income ratio. Willingness to pay is your credit history, your credit score, and how you've handled debts in the past. And the risk involved in the loan is how much skin you have in the game, how much you're putting down versus how much the lender is putting down. And then there's different options with that in regards to mortgage insurance. So, let's talk about stay and rebuild for a minute. What are the options to rebuild and pay for that? One is using your insurance payout, those funds that hopefully you have in the bank or getting into the bank. One is, and each mortgage lender is different. I bet you if we queried the room, you'd have 50 different lender service mortgagers. Is sometimes your current mortgage company will hold those funds for you as you rebuild and pay those out in draws, just like a construction loan. And each bank is different. Each service company that you have with your current mortgage operates that differently. So I can't answer the question in regards to, well, exactly how does that work? Each one is different in there. Another option is to hire a builder, pay cash with the proceeds that you have. And then another option as well is obtain FHA, conventional, or jumbo construction loan, so a construction loan. In general, and each lender is different, The way it works is you have to get qualified. In other words, show what your income is, show what your debts are. You have to show how much money you're putting down. My company, for example, offers a one closing construction loan. So we have you qualified. We also vet your builder. So we have a builder has to fill out questionnaire and paperwork, but they have to show that they're insured. They have to show that they have experience with building homes. There has to be a permit approval. Usually our construction loans, for an example, take about 90 days to process. Once you have the funds available, then you are paying interest on the funds that are currently being used for the construction. So builder comes in, he's pouring foundations, doing subflooring, gets a $100,000 draw. That's the interest you're paying is on that $100,000 draw. He completes another portion of that project, gets another $200,000 draw. Your loan balance is $300,000. You're paying interest on that $300,000. Once the project is complete, once the home is built, certificate of occupancy is issued. The builder has been paid off. Your loan then converts, in most cases, to a 29-year loan. Most of our construction loans are 12-month draws. You have to get your construction done within 12 months, and then your balance is paid over the next 29 years. One close, one loan. There are different models out there, and some of the lenders in the back room may have some different models available to you. FHA also provides construction loans. You can buy land and do a construction loan, or you can already own the land and be able to do a construction loan. These loans aren't for the faintest of heart. I want to warn you. It requires a lot of paperwork. It requires some time, and you want to make sure that you have a builder that is able to produce. While we vet your builder, we don't guarantee it. We go out, sign off on the projects. The title company is also involved during the process. We hire a third party to make sure and manage the draws. I want to talk to you about FHA 203H loans. So these are FHA loans. 203 is actually a remodel type home, and 203H are disaster loans. Now we've done several of these. I've done them for tenants, those of you that were renting and lost the home, and also for owners. Here's the nice part with an FHA loan. FHA loan allows you, basically, let me back up. The government wants you to get housing again. You don't have to decide today, even when you have a 203H loan, whether or not you're going to rebuild. You can put that decision on hold. So you can get an FHA 203H loan, buy a replacement home, as long as that's going to be your primary residence, still hold on to your lot, and even decide later that you're going to rebuild. 100% financing. Mortgage insurance is required. Standard FHA mortgage insurance is required. There's some advantages to this loan. One is you have 12 months. So in other words, you may decide 4 months from now, 6 months from now, you know what? I'm going to go build a home in Boise, Idaho. I'm going to live there. And then later I'm going to make a decision whether I want to rebuild here in Santa Rosa or Sonoma County or Napa County. So that's an option for you. Here's the nice part about FHA. As long as you have insurance coverage to cover your current mortgage and or funds in the bank, along with your insurance to show that you can cover your existing mortgage for the home that you lost, we won't count that mortgage into your debt to income ratio. Remember going back to how you get qualified to purchase a home? We won't count that as part of your debt. The government says, nope, we're going to ignore it. We have to show that you're in communication with your current lender, that you have insurance to cover it, and or that you have enough funds. So an example is, I have an owner I worked with. He just closed escrow 3 weeks ago in the JC neighborhood, lost his home over in Larkfield, 100% financing. Still has all his money in the bank from his insurance payout. His lot just got cleared 2 weeks ago. I drove by it. He has not decided what he's going to do. He has not decided whether he's going to rebuild or sell his lot. You don't have to purchase in the tight housing market we have in here in Sonoma County. If you want to go buy in New York, God bless you, or if you want to go to Boise, you can do that. The requirement is that you lost your home either as a tenant or as an owner in a federally declared disaster area. You have 12 months. Again, I've also worked with some tenants, so we just had a tenant, public safety member of our community, works for Roanoke Park Department of Public Safety, bought a home, 100% financing. He was a tenant. So it was a great opportunity for him. So again, we talked about construction loans, talked about FHA loans. Let's go to the next slide. Vacant lot sales. Anybody have an idea? Anybody know someone, or is your home close to a home that's currently, that lot's for sale? Yeah, there's a lot. And I wanna, where's Marnie and Terry from Next Home Real Estate? Next Home Wine Country Premier provided me with some information to pass on. We pulled MLS, 148 lots currently that are either for sale, in escrow, or have sold since December 1st for Coffee Park, Fountain Grove, Mark West, here in northern part of Sonoma County. What are the prices? Anybody see a lot for $50,000? Call me and let me know if you see one. They're ranging. I know builders are sending out letters. Some builders are buying at $120,000. Some of those lots, especially in Coffee Park, range anywhere from that are on the market, 150 to about 200. Fountain Grove, Mark West, we've seen them at 160. I saw one at 695 on Sky Farm if you're interested. Nice view of the golf course, and if you look at the other side, you can see San Rosa Valley. What we are seeing trend-wise, those homes that are flat lots, easy to build, are selling very quickly. So an example would be most of the lots there in Coffee Park. Most of the builders or most of the buyers are builders. They're coming in, buying lots, turning around, they're going to build a home, and then they're going to sell. Fountain Grove, Mark West is a different problem. Each of those lots, many of those lots are on a hill. They require unique designs to be able to get them built and sold, and those builders that are currently buying right now just don't want to take that time. Volume is key for them, so they can buy several lots, build the same home on several lots, turn it over, make a profit, they're gone. All right. If you have more questions, vacant lots, buy or sell, Morning Terry, raise your hand. They can help you answer those questions. I can try and help you, but I don't sell real estate. I have a real estate broker license, but I don't sell real estate. I sell mortgages, and I will be able to help you, and I'll be here if you have questions. I'm giving you a slight overview of how loans work, different loan options. It's different. It's a little bit different for everybody. There is a variety, and please feel free to contact me anytime, not just tonight. I'll pass out my cards. You can call me on the weekends. You can call me in the evenings. I'm more than happy to answer your questions in different scenarios. And that's what I have. So again, we are, real quickly, Mike's going to talk. He's our CPA. And then all three of us will be here on stage to answer any questions with the mic. We'll pass it around, and then plus we'll be here separately on the side.
Thank you so much, Eric. If you want to give him the mic. I guess, again, just to recap, every decision that you make is yours and shouldn't be based on what your neighbor's doing. Although, you can see we've got these signs all around, and at the end, after we've answered questions, We again are going to encourage people to go over to the sign for your insurance company and gather with the other folks that are insured by that company. And you know that some of these groups, I want to encourage, if there are any group leaders out there, please do shoot us an email at United Policyholders, because we've had people asking who's the group leader for State Farm, and I don't know the answer. Is there a group leader from State Farm here that wants to identify themselves? Okay. The other thing before I pass the mic over to Mike, the Press Democrat, which your local paper, I think has been doing an outstanding job of covering the issues relevant to the fire recovery. And I believe that their coverage of the underinsurance situation has been a really big factor in getting some of the insurance companies to move. Farmers, I understand, has been waiving, not for everyone, but for some people. So again, getting together with people is important. Getting together with people with your same insurance company is important. But if it stresses you out and you feel like, oh my gosh, I'm not getting the same traction that my neighbor is getting, take a breather and remember that this is still early and in the recovery. And you really shouldn't be rushing, and you have time on your side. And as we said in the very first workshop, statistics show that the longer your insurance claim stays open, the more money that you will recover in benefits. So Mike, thank you so much for your time. Again, Mike has both personal and professional experience here, and I give him to you now.
Well, thanks everybody. Sorry for everybody's loss. So that's our itinerary for the next 30 minutes or so. I'm going to try to move through this. Actually, some stuff was covered. In fact, there might be a comment on property taxes and things like that. I'm going to kind of fly through some of this. We do want to get to a point, let's say at 7:30, where we have time for questions. So, but if you have questions and they're not otherwise answered, I'll be here after, and we can talk about what you're dealing with. So, the disaster tax relief. In this federally declared disaster, interestingly enough, and this is not a political comment, there is no process or policy or protocol for this. So every disaster is treated differently, which is very interesting, by the way. So we'll talk about the treatment of reimbursements, casualty loss, gain from involuntary conversion. So there are basically two things that might happen in relationship to your house or your property. You could actually have a gain if you have a low basis in your home, for instance, or you could have a loss. We'll also talk very quickly about business. I realize this is mostly residents, but I'll just mention it in case any of you also suffered a business loss. Go ahead and flip. So this, what I'm going to be talking about does apply to all the counties mentioned above, obviously us. When I talk a couple of terms of art, when I talk about reimbursement, that would include everything. So that would include things you got from Redwood Credit Union, Rotary, FEMA, whatever. Go ahead and flip. Oh, you know what, by the way, before I get started too, basis is something we'll talk about, and I just kind of want to plant a seed. Cost basis. So for instance, if you buy a share of Intel stock for $100, your cost basis is $100. When we mention basis regarding your personal residence, it's how much you paid for it, also including any improvements that you may have done, a pool, landscaping, a deck, concrete. Also consider when somebody passes, you get a step up in basis. So that same share of Intel stock that I paid $100 for, let's say I die the next day and it's worth $1,000, my wife's basis in that Intel stock is $1,000. So you get your basis by buying it, you get your basis by dying, okay? So basis is going to be an important thing, and we're going to run through some numbers. I believe Amy had mentioned this presentation is going to go up on their website. And so these slides are going to be up on their website. there's going to be some numbers, and literally you could take those numbers and kind of line out the example numbers and put your own numbers in, and you could do your own little calculations, okay? So anyways, this additional time thing isn't as important now because what is it? It's January 25th. And we all got, I don't know, I was worried about doing tax returns on the 9th of October, okay, because the due date was the 15th. Well, in this federally declared disaster, we get an extension to finish those extended returns as well as any, pay estimates or payroll tax returns until January 31st, which is coming up. And by the way, I'm still doing those 1015 tax returns right now. So most of you, that probably doesn't matter. Hopefully you filed a long time ago. Let's flip the slide. I won't talk about the property assessment. The personal casualty loss, so remember this, if you do have a loss, there is a rule for throwback. So this loss happened October of 2017. However, because it's a federally declared disaster, you can take the loss in 16. So that's where, they keep saying you ought to talk to somebody that at least has a clue, okay? Because you need to look at your returns, and if you have a loss, it may be worth it to take it in 16 versus 17 or vice versa, okay? The casualty loss for personal is subject to a 10% of AGI limitation. It may be as easy as looking at the very bottom of page 11040 and the lower number versus 16 or 17 may be the year you take your loss if you have one, okay? Go ahead and flip the slide. Here's the good news, okay? Your property, your personal property settlement money, your living expense money is not taxable, period, because it's a federally declared disaster. So really the only thing we're worried about is the building money. Taxable payments, though, could include unemployment comp, reimbursements for things you've been reimbursed for, which is probably not going to happen, and payments in excess of your basis in your personal residence. But don't be too afraid of that. We have the personal residence exclusion 2 out of the last 5 years, and I'll cover that in a bit more detail in a minute. Go ahead and flip. So what is a casualty loss? Damage, destruction, loss of everything. The fire was a casualty loss, basically. And for all of you who, let's say, lost your house in its entirety, it's very permanent, okay? So that permanent thing is important, though. For instance, if one tree burned down in your property, that is not probably a casualty loss because it's not permanent. You could literally plant another tree and it would grow, and that's kind of how the IRS looks at this. By the way, we are in a gray area. So when you're in a gray area, you are in case law. And the case law could probably fill up this room. And so literally there are case law and tree loss. So if you lose enough trees, if it affected the fair market value of your property in its entirety, potentially you do have a casualty if you lost some trees. But again, it's a very facts and circumstances, and hopefully your facts and circumstances line up with a case that actually won, right? Casualty loss is not typical day-to-day occurrence, so it's not something like dry rot or your roof, 40 years later is obviously not new and probably not in great shape. Again, must be permanent. That's a very significant thing for those of you that may have had just damage to your house versus an entire loss. So tax deductions that generally occur when damage exceed reimbursements. Again, I'm talking about this 10% of AGI limitation. So just $500,000 of AGI. Let's hope we were that, we did that well. That means you've got to clear a $50,000 bar, $50,001 to get $1 of deduction. Okay, so there's a 10% reduction effectively in your loss. Damages equal to the lesser of the decrease in fair market value, which is difficult to define, or your basis, the lesser of the change in fair market value or your basis. So you can see that you need to understand what your house was worth before and what it was after. For those of you who lost your house in its entirety, that may be fairly simple. Again, basis is important and you need to know that. Let's see. Reimbursements include all payments received for damaged property. Again, it's that thing where even the non-taxable payments need to be considered, like your RCU money and things like that. As an aside, you will not get a casualty loss unless an insurance claim has been filed. So loss substantiation, by the way, from the IRS, and I don't know if anybody's gone through an IRS audit before, and I hope you haven't. It's all about documentation. You can't go in there with this is just fair and I deserve this. You're going to lose. So you need good documentation, which, by the way, is not that different than what you're going to have to do for the insurance company. Okay? Must be able to show the following, and you can read that. So this is where the examples start. I realize that everybody probably, is having a rough time seeing this. Home purchase for $400,000 last year. Again, basis becomes very important. Property tax statement, allocated $100,000 to the land. We haven't lost the land. We still have the land, so we need to take some of that basis and allocate it to the land because we only lost the building. And $300,000 to the building. Total expected insurance reimbursement of $200,000. FEMA repair assistant payment, just look at that $50,000 as like some kind of magical, I'm not sure any of us received $50,000, but just some kind of magical number, right, that we received from somebody else. And then fair market value prior to the loss was $475,000. So as we go through this calculation, $300,000 of basis, $200,000 of insurance reimbursement, and $50,000 of assistance. So we lost 50 grand, right? We had something that we paid $300,000 for. We only got $250,000 back. Less that 10% AGI, if we're assuming that AGI is $100,000, less the $100 floor, which is idiotic. We have casualty loss at $39,900. Okay. So I don't know. All this has to do with when you bought your house. So I'll give you an example. And if you bought your house in 2007 or 2006, you might have a loss. If you bought it in 1990, you probably have a gain. Okay? Basis of property after casualty loss. So once you take a loss on that property, I'm not saying that the Internal Revenue Code is fair, but it does have some components that are economic. If we take that loss and deduct it, we have to reduce our basis. Okay? So our basis, what we paid for it, or if we inherited it, for instance, as a result of a death, we'd have to decrease that basis by insurance, casualty loss taken, and possibly increase by the amount if we decide to rebuild, right? Here's the other way, okay? This is the basis calc, and I'm not going to go through this, but effectively, if you rebuild your house and you had enough insurance proceeds, likely you're going to have the same basis. You've effectively carried it forward. I'm going to ask this question. A lot of what we're doing here, you're going to see in the next couple slides, is much like a 1031. What you're doing is just that fire inadvertently converted or inadvertently sold your house, right? So here's a gain scenario, okay? And we're using something called involuntary conversion, which doesn't sound very fun. But again, this is very much like a 1031, so for those of you in real estate or maybe investors, you'll understand this. This involuntary conversion results when your property is destroyed, stolen, condemned, eminent domain, that kind of stuff. So you've literally converted something to cash and you didn't really mean to or want to. The gain will generally occur if reimbursements exceed basis, which makes sense, right? We've kind of inadvertently or involuntarily sold our property. For residents, we may be able to use the gain exclusion, and for those of you who haven't been keeping up, there isn't a rollover provision any longer. We have a gain exclusion provision. If you've used this or lived in this house 2 out of the last 5 years as your personal residence, married can use $500,000 of exclusion, and single can use $250,000. In an involuntary conversion, if we replace the property, there will be no gain. Okay? we'll be able to defer the gain. If we don't replace the property, potentially we have a gain. Again, just like we sold our property, just like we sold a house, okay? To defer the gain, replacement property must cost at least as much as the amount you received as reimbursement, minus any excluded gain. And I'm going to go through, we're going to go through some numbers here, okay? But just logically, think about it this way. If you come out ahead, do you think the IRS is going to let you just walk away with it? Okay. So when postponing your gain, your ownership period includes the period you own. So in other words, you're gonna, if you rebuilt your house and turned around and sold it, and you bought that house in 1990, you get the holding period from 1990. It doesn't reset, okay? Now, normally in involuntary conversion, the replacement period is 2 years. Because it's a federally declared disaster, you have 4 years, okay? I'm going to mention, and I don't know if this is a slide, and it's just popping in my head. All of you who have this scenario where you've bought your house a long time ago and you had low basis and you're getting plenty of replacement money, you will have a disclosure in your tax return. So this is where the TurboTax thing probably isn't going to work, okay? You will have a disclosure in tax return because you've got to tell them, here's how much I think I'm going to get in insurance, here's how much I have in basis in my home, and I'm planning to replace the property, right? If you don't think you're going to replace the property, you have a gain, and you probably should report it, okay? But if you don't know, then you got to defer it, okay? So here's our gain calculation. $800,000 of insurance proceeds. Our basis is $125,000. Again, remember this is structural only. We still have the land, so we need to allocate that away. Let's assume that this was a personal residence, so we can exclude $500,000 right off the bat. So our proceeds realized are really only $300,000. Proceeds less basis, we have $175,000 worth of gain. Proceeds realized $300,000 less cost of new home. In other words, if we reinvest $275,000 into a new home, we only have a $25,000 gain, and we're going to have to pay taxes on it. We've deferred $150,000. The new house of $275,000's basis is now $125,000. Okay? So again, the mechanics of this, I'm going through very quickly. It's a gain deferral. We're not going to get away with anything, okay, is the point. Okay? If we don't recognize the gain now, that deferred gain is going to roll into our replacement property. Okay? And I do this for a living, and this totally makes sense to me in my head. It doesn't have to make sense to you. Okay? So what I'm going to do is I think we got about 5 minutes. So there's a couple of things here. You need to go back and you need to figure out what your basis in the property was. You also need to go back and think about what's going to happen. Okay, how much insurance do I think I'm going to get for my building? Okay? And then just do the quick math. Do I have a gain or do I have a loss? Okay? If you have a gain, you're kind of done, other than the disclosure issues that we're talking about. If you have a loss, you may want to consider looking at the fair market value change. Okay? But you don't need to do that if you've got a gain. Okay? You need those things that I just talked about when you go see your tax preparer. Okay? I don't know how, I can look out in here, I actually know some people, but I look out here and I don't know what everybody's tax return looks like. I don't think you need to pay somebody $300 an hour to prepare your returns, okay, generally speaking. If you had a W-2 and were a homeowner, most people could prepare that tax return. But I would not take your casualty loss to H&R Block, okay? But they might be able to prepare the rest of your return, but talk to somebody that knows a little bit about the casualty loss, just to make sure that you're okay. So I tell people oftentimes, if they feel comfortable doing their own return, do it. And then let somebody look at it, You know, this is one of those times where you probably want somebody to look at it. And truth be told, I probably don't want to prepare your return. I'm not even sure I could. We're just so slammed and busy. But having said that, I'd be happy to talk to anybody and just kind of walk them through or help them understand what their return is doing, okay? So on the business matters, I'm not going to talk about this a lot. There is no such thing as the fair market value consideration in the loss calc, so it's simply a basis and proceeds calculation. There is no 10% of AGI in a business calc. Go ahead and flip. There is no $500,000 exclusion in a business calc. So in a lot of ways, it's much simpler. Go ahead and flip. What this is about is that when in replacement property, if you lost a business, you could actually go buy a business. So if you lost a restaurant, potentially you could go buy a bowling alley or something like that. Go ahead and flip. Loss of inventory, lease property. Again, I think this is mostly about residential, so I'm not going to cover this too much. But if you've got questions, I'm happy to address them after in our question and answer period. Hopefully you guys don't have a partial business use property. You know, even an office in the home, that's going to create some math and a spreadsheet and a multi-column spreadsheet. Okay. Very quickly too, net operating losses. If you do have a significant casualty loss in your personal return, potentially it creates an NOL, which is carried back, carried forward, that kind of thing. 3-year carryback, by the way, in the NOL, as opposed to the normal 2. There you go. Okay, thanks very much. Good luck, everybody.